The Fed leaving interest rates unchanged as expected and sticking with an earlier forecast of 3 rate cuts by the end of the year. Here for his reaction is our friend Dfedennis Lockhart, former Atlanta Fed President. Mr. Lockhart, good to have you back with us. I guess I don't see much in the statement or the action, which is a non-action, to suggest that the Fed is becoming more hawkish. I'd like to get your reaction to that. But I do sense that maybe they're just becoming more patient, which is not necessarily a bad thing.
Yeah, I think your conclusion is correct. I would say, however, if you look at the dot plot, you do see some movement in the dots. There were, I think, 4 dots. That is 4 moves, and they have all but one have moved into the 3 category. The consensus is pretty tight, around 3 moves this year. And I think that's the takeaway, that the consensus has tightened.
What about the big boost to the GDP forecast to 2.1% from 1.4%? What do you make of that? And is that sort of the Fed setting themselves up for saying, look, the economy is getting stronger. That's why we've got these 3 cuts planned?
Yeah, I think they're recognizing that the underlying demand in the economy, the underlying strength is pretty robust, and that's why I think they're sticking with 3 rate cuts, because they see that they have that strength of the economy to deal with.
Take us inside the meeting. Since the last meeting, we've had a couple of inflation numbers that have been, to some, a little bit worrisome. What is the discussion like about numbers that were above what Wall Street and economists were forecasting?
Well, they're not dismissed, but they're looked at in the context of being, just one report or 1 or 2 reports. So there's not generally not an overreaction to that. I think, as Jay Powell has said frequently, there's no expectation that this disinflation will be linear and it just will come down in an even fashion month over month over month. So I think they reserve judgment, and I believe that the reports we've seen recently, to a small degree, reset the clock, because they need to look at another 2 or 3 months of inflation reports to be sure that what they're seeing is just a bump and not something that's signaling a real change of direction.
And that's sort of what I was going to ask, is how many reports do you need to see in a row to consider it a pattern for inflation, for instance? Obviously, inflation has sort of been this sticking point. And how do you know when it's just a bump or it is a new trend that the Fed should take appropriate action on?
I think different members of the committee might have different answers to that. I would personally say I would be looking for 3. To fully interpret what's gone on with the January and February reports. So it would be, past, in all likelihood, past the May meeting.
Is there an unemployment number? Rick Santelli just mentioned the idea that unemployment is about a half point higher than it was at this time a year ago. His prediction was that it may go above 4% on the next number that comes out in about 10 days. Is there an unemployment number that would cause the Fed to begin to worry about that? Because full employment is part of its mandate.
Well, first, there are good and bad reasons why unemployment numbers rise. When you have people coming into the workforce and increasing participation, that's a good reason for the unemployment rate to rise. So they would look within the numbers to see what the dynamic really is. But if you're seeing layoffs and you're seeing widespread downsizing of companies and so forth, beyond 4% would begin to, I think, get the attention of people on the committee.